Reserve Bank of India's Prudential Norms on Capital Adequacy for Small Finance Banks 2025. These directions are aligned with the global Basel III framework and are specifically tailored to the operational structure and risk profile of small finance banks in India. The objective of these norms is to ensure that small finance banks maintain adequate capital to absorb losses, protect depositors, and promote long-term financial stability. This presentation will walk you through the key concepts: capital structure, risk-weighted assets, securitization norms, leverage requirements, and disclosure obligations prescribed by the Reserve Bank of India. Let us begin by understanding the legal foundation and applicability of these directions. The Prudential Norms on Capital Adequacy have been issued by the Reserve Bank of India under the provisions of the Banking Regulation Act 1949. These directions apply exclusively to small finance banks operating in India and supersede earlier capital adequacy instructions issued to them. Through these directions, the RBI ensures that small finance banks follow a uniform and robust capital framework that is consistent with international standards while addressing domestic regulatory needs. Capital adequacy is the foundation of a sound banking system. It ensures that a bank has sufficient financial strength to withstand unexpected losses arising from credit defaults, market volatility, or operational failures. For small finance banks, maintaining adequate capital is particularly important because of their focus on priority sector lending, financial inclusion, and exposure to high-risk borrower segments. These norms help ensure that growth is supported by resilience and prudent risk management. Under the RBI framework, regulatory capital for small finance banks is classified into three categories: Common Equity Tier 1 capital, Additional Tier 1 capital, and Tier 2 capital. Each category has specific eligibility criteria and loss absorption characteristics. Together, they form the total capital base against which regulatory capital ratios are assessed. Common Equity Tier 1 capital represents the highest quality and most reliable form of capital. It primarily consists of paid-up equity capital, statutory reserves, and retained earnings that are freely available to absorb losses. Certain items such as goodwill, deferred tax assets, and specified investments in financial entities must be deducted from CET1 capital. This ensures that only truly loss-absorbing capital is recognized at the core level. Additional Tier 1 capital includes perpetual instruments that do not have a fixed maturity date. These instruments allow banks to absorb losses on a going concern basis after CET1 capital is exhausted. Coupons on at-one instruments are fully discretionary, and these instruments may be converted into equity or written down when the bank's capital falls below prescribed thresholds. This feature enhances the resilience of the banking system during periods of stress. Tier 2 capital consists of subordinated debt instruments and certain general provisions. These instruments absorb losses only in the event of liquidation and therefore carry stricter eligibility conditions. Tier 2 capital plays a supporting role by providing additional loss absorption capacity beyond Tier 1 capital, while ensuring that depositors and senior creditors are protected. Small finance banks are required to maintain minimum capital ratios calculated as a percentage of their risk-weighted assets. These include minimum thresholds for CET1 capital, Tier 1 capital, and total capital. In addition to minimum capital ratios, banks must maintain a capital conservation buffer, which acts as a cushion during periods of financial stress and restricts discretionary payouts when capital levels decline. Risk-weighted assets form the denominator for capital adequacy calculations. They reflect the level of risk associated with a bank's assets and off-balance sheet exposures. The RBI framework requires small finance banks to calculate risk-weighted assets for credit risk, market risk, and operational risk, ensuring that high-risk exposures attract higher capital requirements. Credit risk capital requirements depend on the nature of the borrower, the presence of collateral, external credit ratings, and the maturity of the exposure. Rated exposures are assigned risk weights based on their credit rating, while unrated exposures attract more conservative risk weights. This ensures prudent capital allocation and discourages excessive risk-taking. Securitization exposures are subject to specialized capital treatment due to their structured nature. The risk weight assigned depends on factors such as tranche seniority, credit rating, maturity, and tranche thickness. Senior tranches generally attract lower risk weights, while junior or thin tranches attract significantly higher capital charges, reflecting their higher loss absorption risk. The RBI has introduced a separate capital treatment for simple, transparent, and comparable securitizations, commonly referred to as STC securitizations. When all prescribed criteria are satisfied, these securitization transactions are eligible for lower risk weights. This framework promotes transparency and encourages safer securitization practices within the banking system. In addition to risk-based capital ratios, small finance banks must maintain a leverage ratio. This ratio compares Tier 1 capital to the bank's total exposure, including on-balance sheet and off-balance sheet items. The leverage ratio acts as a non-risk-based backstop, preventing excessive leverage even when risk weights appear low. Transparency is a critical element of the capital adequacy framework. Small finance banks are required to make detailed Basel III disclosures relating to capital composition, risk exposures, capital ratios, and leverage metrics. These disclosures enable market participants, regulators, and stakeholders to assess the financial strength and risk profile of banks accurately. The Reserve Bank of India closely monitors compliance with capital adequacy norms. Failure to maintain prescribed capital levels may result in supervisory action, including restrictions on dividend distribution and requirements for capital restoration plans. Strict adherence to these norms is essential for regulatory compliance and long-term sustainability. With the issuance of these directions, earlier capital adequacy guidelines applicable to small finance banks stand repealed. However, actions taken under previous guidelines remain valid, and transitional provisions apply where specified. This ensures regulatory continuity while moving to a more robust framework. With the issuance of these directions, earlier capital adequacy guidelines applicable to small finance banks stand repealed. However, actions taken under previous guidelines remain valid, and transitional provisions apply where specified. This ensures regulatory continuity while moving to a more robust framework. To conclude, the RBI Prudential Norms on Capital Adequacy for Small Finance Banks 2025 establish a strong and comprehensive framework that enhances financial stability, strengthens risk management, and aligns Indian banking with global best practices. By ensuring adequate capital buffers, disciplined risk assessment, and transparent disclosures, these norms protect depositors and reinforce confidence in the small finance banking sector. Moonses and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence, a pioneer in establishing SEZ and IFSC units within GIFT City and India, delivering end-to-end IFSC setup, operational support, and handling complaints. Risk management, renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university BAT, and ancillary regulations, and fintech, expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF if CSCA, comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network, scan the QR codes below to stay connected with us.